This is the Business Stuff Podcast. This is where I will share the lessons I've learned from advising thousands of businesses over almost 30 years. Each episode will give you practical insight to allow you to learn from other people's mistakes. I'll be pulling in experts from our team and the world of business, and together we'll make sure your business is giving you what you want. My name is Martin, and this is the Business Stuff Podcast.
Hello, it's Jack here from the Accelerator team, and I'm joined by Lorraine.
Hello.
Lorraine from our tax advisory team. And we're going to be talking about something that's obviously very important and topical at the moment, which is the World Cup.
Yeah, I'm not very good at that.
Right, we'll stick to your strengths then. We'll talk about the autumn statement then. Obviously, it came out last week. We're recording on Monday, just after the autumn statement. Yeah. So we've had a bit of time to digest it and think about things. So I just wanted, to start off with, what are kind of your high-level thoughts? Do you think it's kind of inspired a bit more confidence compared to what happened back in September when we had that little...
Well, I think absolutely, yes. I think, as soon as the September statement was announced, there was a lot of press coverage, and I think everyone expected fully that there were going to have to be some changes made to the announcements there. So this has given some stability, I think. I think really we haven't got anything overwhelmingly fancy in this budget. It's just basically little tweaks here and there, which in isolation might not make a massive difference to people or businesses, but actually when you add them up, if you're impacted by a few of them, then you could see your income be challenged somewhat.
Yeah, it's interesting. I feel like maybe a lot of the sexy stuff probably being announced prior to this, probably when they were rolling back on stuff that happened in September. So that, as a result, there probably wasn't a huge amount to actually talk about and release at the autumn statement itself. Exactly.
And I think a lot of the issues have been leaked as well beforehand. So I think, although with capital gains tax, for example, which we will come to in due course, for all that wasn't something anyone ever expected, it was kind of being talked about in the days leading up to the statement.
Certainly,
So when it was announced, it wasn't a shock.
Mm-hmm. It is quite interesting because I was just at the UK 200 conference last week, and we had a chat by one of the economists at Danske Bank over in Belfast, and he had a really interesting synopsis of why September was probably so much more disastrous compared to this in terms of like reactions with the market. And it was essentially down to like the economic levers themselves. So we've got obviously fiscal policy on one side, which is how the government choose to spend our money and how they tax us. And also we've got monetary policy on the other side, where we've got the Bank of England kind of tweaking in interest rates in order to kind of affect the money supply, I suppose. And what seemed to happen in September was that those two policies were almost kind of pulling against each other. So on one side you had the fiscal policy, which is encouraging a huge amount of growth. Everyone's going like, we're going to cut taxes, everything's going to be a lot cheaper to, you're going to have a lot more disposable income. And on the other side, you had the Bank of England that were putting up interest rates, trying to cool down inflation, trying to get people to save money. So as a result, I think the markets got very confused, but this seems to be a lot more kind of in sync with each other. Now interest rates are probably going to, have risen and may rise again. Yeah. And now we've got a more kind of conservative budget in terms of like modest tax rises.
Exactly.
And it's trying to cool everything down.
Exactly.
But I just thought that was really interesting. So I'm ripping off someone's ideas. These aren't my ideas. But, this is essentially what I do on the podcast. So should we get into the detail of it then? So
definitely.
Is it probably best to kind of touch on like the personal tax side of things?
Yeah, we can kick off with that. So again, nothing massively contentious in terms of the personal allowances. It's just been frozen. Ordinarily we would see an inflationary increase every year, and it does help people. It gives them an extra £10, £20 here and there in their monthly income coming through. That has been frozen. People will feel a pinch there, but it's not it's not a big change. The 20% tax rate for basic rate taxpayers stays and is here with us. I think the most interesting point that came out was the reduction in the point at which the additional rate kicks in. So that previously was at £150,000. That's now been reduced to £125,140.
Yeah.
So that's going to impact anyone with earnings over £100,000 basically, because as you know, £100,000 they start to lose their personal allowance anyway. And where their income sits between 100,000 and 125,140, that there is that idea of that effective marginal rate of tax of 60%, and then it falls back down to the 40% ordinarily afterwards. That's going to now fall down to 45%. So there is that 5% increase there for people. So they're going to feel that. And I've worked that out to, it's about £1,200 in tax. Again, it's not a massive amount, but you add that to the fact the personal allowance has been frozen. These little changes are going to impact people.
Yeah, it's really interesting, and had to do quite a lot of research, more research than I'm used to doing on the podcast, in terms of actually understanding, because there's been so much change going on in the past. I mean, if we think about it, back in March 2022, Mr. Sunak, when he was Chancellor, announced that we were going to reduce the basic rate of tax to 19%. We then had the September budget where they decided to kind of bring that forward to April 23, because I think it was initially going to take effect from April 2024. I'm having to look at my notes here because it's that complicated. And also they were planning on abolishing the 45% rate of tax at that point as well.
Yes.
And now we've kind of gone full circle where kind of normal service has been resumed and everything's been rolled back significantly. Is it worth kind of pointing out that these changes are definitely going to affect England, but not necessarily Scotland and Wales, who have got their own powers of...
Exactly, yes. They obviously have their own rules. We're not going to go into detail on that today. Yeah. We're not going to go into any detail on that today, I'm afraid.
Other than saying that anyone who's in Scotland and Wales, don't take this as gospel, because there may be some changes.
There may be changes. They have been given the powers to do that, yeah, exactly.
Excellent.
And while we're talking about personal taxes, the dividend allowance as well, that's been reduced from, it's currently £2,000, the first £2,000 there, it's been reduced to £1,000 and then £500 from 24-25. Sorry, I'm just catching up on my notes there.
And I suppose people are probably asking why this allowance kind of exists in its in itself, because it's something that's come in. I can't remember when it came in, but it started off at £5,000, didn't it? It
did, yes. It came in a few years ago. Historically, we had this idea of the notional tax credit on dividends, and it was all a bit fiddly. And they abolished the notional tax credit. They introduced an allowance, if you like, where you wouldn't pay tax on the first £5,000 of your dividend income. What that enabled people to do was, if you've got a relatively modest dividend income stream, and you're just a regular investor that's just got a few stocks and shares somewhere, it eradicated the need to complete a tax return and removed a lot of people out of self-assessment tax return reporting requirements. That's coming down. So what we're going to see there, whilst again it might not be a massive tax problem for people, but actually they may now have to start reporting again because
the additional cost of that, particularly or admin in terms of either have to fill out a tax return or getting someone else, an accountant, to do it for you, or a tax advisor.
And also when you think about what is relatively potentially going to be quite a small tax liability, but they're going to have to pay somebody to do a tax return if they're not confident to do their own.
Exactly, yeah.
Using HMRC software.
But yeah, it was primarily aimed for kind of maybe the pensioner who's either inherited from their spouse some kind of historic dividend investments, and so it stops them. But potentially could, as you said, bring a lot more people into scope for reporting for personal tax and self-assessment going forward. So that's interesting.
Yep.
Is there anything else on the personal tax side of things?
No, I wouldn't have said so, really. I think that was they were the main issues that are arising.
It's probably a similar story to the tax rates and allowances stuff, though, that has been so much change on that in terms of the increases by 1.25% across the board for the health and social care levy, which has then also been rolled back, but still those rates still remain the same, though, in terms of kind of the dividend rates remain at that additional 1.25%. Cool.
And jumping from that, really, just to it flows on nicely from there. The national insurance rates, they've all been frozen as well. So there's nothing really to say much about national insurance.
Good, we like that because it's quite a complex area.
Yeah, well, I think obviously there's been quite a few changes on that during the year. So from a reporting perspective, employers have had a bit of a nightmare with that, but at least now they know this is what it's going to be, and that's...
Yeah, certainly I'm sure our payroll department will testify to it being very complicated, and I think software providers have probably struggled quite a lot as well in terms of keeping up with it, so we can't necessarily rely on your software provider to make sure it's guaranteed.
Yeah, I think I'd be checking things if it was me. So.
Yeah. In terms of employee stuff, there wasn't a huge amount of things on there other than company cars.
Exactly, the company cars. And really, it wasn't so much that there was any changes announced. It was more just giving, that idea of this is what it's going to be. So people now know with confidence this is what the benefit in kind rules are going to be for the next few years. So jumping straight into the electric vehicles, the benefit in kind is currently 2%. That's going to rise by 1% every year, going up into 27, 28, up to a maximum of 5% of the list price of that vehicle. And all of the cars they'll increase by 1%.
Just for a one-off?
A one-off hit, yeah.
So it's still obviously more tax efficient to have an electric vehicle, but less so than it would be.
Absolutely. I mean, if you think you're paying a maximum of 5% on an electric vehicle versus 37% on a non-electric vehicle, and there's rules for vehicles that are kind of fall in between, like your hybrids. Yeah, your
low emission cars.
Low emission cars, exactly. Yeah.
Yeah. So it's well, obviously, if you did have a gas guzzling diesel at the highest rate, you'd probably be questioning why have you got it as a company car to start off with, because maybe not the most tax efficient. It's not the most tax efficient, but
you'd be surprised that they are floating around still.
Definitely, yeah. I suppose another couple of things to run off on the employees very briefly is national living wage is increasing to £10.42 going into April, and maybe touch on IR35 again. Nothing's actually changed other than making people aware that the stuff that was announced in September has been rolled back. So
exactly,
people who didn't necessarily worry about IR30, we're not worrying about IR35 again, and need to start worrying about it, I suppose.
Exactly, and I think as ever it just remains a massive grey area, and no two situations are the same. So it's just something you've got to look at each case in its own right, really, on IR35.
Yeah, perfect. Again, keeping on the kind of no news is good news sort of thing, there was some stuff announced on inheritance tax, but nothing really that much exciting.
Nothing exciting other than to confirm that the nil rate bands that are in place at the moment are here. They're frozen. They've been frozen further, but they've been the same for a long time now. So the nil rate band's staying at 325,000, and the residence nil rate band's staying at 175,000. And they did confirm that the abatement, the 2 million abatement, for that residence nil rate band is also frozen at 2 million. So the rule, nothing changes there with inheritance tax.
And a similar story for kind of pensions and trusts and stuff
well,
like that.
with pensions, we there was almost an anticipation that something might have been announced on the pension charges and the annual allowance charge. So just to recap, there's an annual allowance of £40,000. If your pension grows by more than the £40,000, potentially you could be subject to an income tax charge.
Okay.
On the growth in excess of £40,000. And a lot of people, obviously with inflation being where it's at the moment, a lot of people's pension pots are finding that they are growing faster than they were. But there was no announcement about that at all. So the only thing really with the pensions is with the healthcare sector, they're looking at when they apply, at what point in the year do they look at when they apply the inflation rate.
Right.
That might help, but we still haven't had any announcements on that.
That's one of those no news is good news sort of things, I suppose.
Or
is it just something you're like, oh God, something's going to come down further down the line? And
I think if anything, I would have probably expected something more on the relief side there rather than it coming down. Him actually making an announcement to extend the annual allowance or provide some sort of temporary measure while we're in this period of inflation, but there was nothing.
So going on to an area where there's actually been relatively quite a lot of changes, or relative I suppose, so capital gains tax.
Yes, the annual exemption, which we haven't seen changes to, well, it's certainly in my entire career in tax, other than the annual inflationary rises. The current annual exempt amount is £12,300. that is actually going to be reduced to £6,000 with effect from next April.
That's a big cut though, isn't it?
It is a big cut, it is. And then it's going to go down even further to £3,000 from April 2024. So
massive, basically.
So, and potentially, who knows, is this the road for the annual exempt amount to go? Who knows? But £3,000 is certainly a lot lower than the 12,300 that we're seeing at the moment. So that is going to impact, especially if you think about a married couple, where currently they've got just over £24,000 of gains that are exempt. They're going to have only £6,000 between them going forward. So it is going to impact. It's not a massive amount of money when you look at it, but it is enough. We're talking an additional £1,700 in capital gains tax if somebody sells a residential property when it goes down to £6,000, which is a lot of money still.
Yeah, and especially because there are those kind of separate rates of capital gains for residential properties against other kind of assets.
Yeah.
So people who are selling residential properties outside of their primary residence are going to be the ones that suffer the most potentially.
Yes, and again we come back down to that idea of reporting as well, because the reporting requirements, if you didn't make a gain, obviously you didn't have to report, but now more people are going to be making gains. They're going to have to be reporting those gains as well and submitting tax returns to HMRC. If it's residential property, they're going to be falling within the 60-day return window as well.
And this is an area that I don't think anyone knows a huge amount about, even people that may have a lot of residential properties held personally. Like we still speak to clients about that, and they don't understand that what do you mean I have to make a submission? Surely I do that in January.
Exactly, because historically that's how they reported those gains, and now the rules have been in place for a few years now. But we do still keep finding people that it comes through their tax return for the year. Oh, I sold this property last year. Okay, but that should have been reported. So they find themselves in a position where they've got penalties to pay. So residential properties must be reported within 60 days where there's tax to pay.
Yeah, but I suppose it could have been a lot worse because they were floating the ideas of potentially increasing the rates of capital gains tax. Various rumours going around, which obviously would have been a lot worse potentially, but still not great news for people.
No. I suppose the only thing we would say is that as far as I'm aware, there are no transitional measures on this. It is in place and it starts in April. So if there are any sales that were, are in place, just make sure you complete those before April if you possibly can. Although I understand that that's not exactly easy to
particularly when you're dealing with conveyancing and
exactly, and the market the way it is as well at the moment. And just while we're talking about the annual exemptions, that rule applies for the trust annual exemption as well, which was already half of the individuals.
Okay.
So the trust annual exemption is coming down to £3,000 and £1,500.
Wow.
Respectively.
Okay. Interesting. So that's all on CGT. So last thing's probably to with is kind of the corporate side of things, like corporation tax. I suppose the first one to pick up on is the annual investment allowance.
Yes,
there is some good news there.
There is some good news there. So the annual investment allowance, there was a temporary measure to increase the limit to £1 million, so 100% annual investment allowance on £1 million worth of expenditure on plant and machinery. That has been confirmed that is here to stay. It's a permanent measure now, so it's not going to be reducing back down to its lower limits.
Which is great. I suppose that's, because I saw the stat, I think the crunching numbers, and 99% of companies or people that used it were spending less than £1 million on plant and machinery, which I suppose kind of figures. Yeah,
a lot of businesses are. And then just to extend on that as well, back to the electric vehicle issues we were talking about before. There's 100% first year allowance for the installation and cost of electric charging points, and that's here with us until 2025. So I think we are going to be seeing more and more businesses with electric vehicles. If you're thinking about getting a charge point in, it's time to start getting that in.
Definitely, and that might be an additional incentive for people to go out and make that change.
Exactly.
The rate of corporation tax, again, that's been somewhat of a yo-yo issue going on.
It has been, and now we have confirmed rates. So it's currently 19%. That's with us until March 2023. And then we're going to enter back into the rules of marginal rates of corporation tax, which
an accountant's dream and a tax
Yeah.
advisor's dream.
which it was great when they were abolished. Now they're coming back. So basically, you're going to fall into this marginal rate, and if your company's profits are between £50,000 and £250,000, the effective rate sitting in that that sort of band is 26.5%.
Interesting.
It is interesting, given that the highest rate a company would pay would be 25% on profits in excess of 250,000. So if you're sitting in that marginal rate band, you're going to be paying. You're actually paying more tax, effectively, than companies earning more profit than you.
That's really interesting. And obviously, any profits below 50,000 stay at that 19%.
Exactly.
So, interesting. But yeah, as we said, it was an issue where obviously this 25% rate has always been on the cards when Rishi Sunak was Chancellor, and then that idea was completely scrapped in the September statement, and then obviously it's come back again. So again, it's keeping us busy anyway, isn't it?
It is. All these rates are keeping us busy, definitely.
It's worth touching on the super deduction as well.
Yeah.
So that was introduced during COVID to encourage people to continue to invest in these uncertain times. So that an additional 30%, on top of what they would have normally got for investing in plant and machinery.
Yeah.
That comes to an end in March 23.
23, yeah.
Which is fine, but if your year end spans that, then there is some potential transition rules to put in place to ultimately prevent you from getting more tax relief than you would if you had done it during, before, in a period where your year end coincided with it, because there potentially would be some scope. So essentially, I think at the heart of it is that it's to ensure you don't get any more than the 25% tax relief that you would have got if you'd done it in a period that ended in March 23.
Exactly, and if the period straddles that date, then you know, what I would say to people is just get in touch and we can crunch the numbers, and if there's anything that can be done, we can see. It's
never straightforward.
No.
I suppose the last area of corporation tax then is R&D. So
Yes.
This is the reason why I'm here, probably. So yeah, the R&D stuff kind of sneaked under the radar a bit for me. I mean, there were rumblings again. I think there were rumours going around. The FT were talking about it on the Wednesday about the idea of them changing the R&D rates, and I was busy most of Thursday, so I didn't really see until I got onto LinkedIn on Friday, where I actually saw that they had made some changes which the BBC didn't report on, which I was looking at. So basically, under the two schemes under R&D, and feel free to jump in at any point if I get anything wrong, because there's a lot of numbers going on here. On the SME side of things, you did traditionally get an additional 130% uplift on your qualifying R&D costs.
Yeah.
So for every £100 that you spent on R&D, you get an additional 130 back, and you basically get a combined tax relief of 230%. The Chancellor has now reduced that down from that 130% down to 86%. So,
which is a big jump.
But according, the ONS apparently have looked at it, and it's not going to have a material effect on R&D spending. The jury's probably still out on that. The other side of the SME is that if your R&D enhanced deduction, that additional 130% pushed you from a taxable profit to a taxable loss, you could claim a tax credit on that loss that you made, which was traditionally at 14.5%. They've now reduced that to 10%.
Yes.
Which is, again, massive, particularly if you're going to factor in the increase in the rate of corporation tax to 25% potentially, excluding marginal rate, 25% maximum that you're going to pay. So potentially that will change some decisions around whether to take the tax credit or not, because suddenly now you've got a 15% discrepancy between leaving those losses to be carried forward and offset against future profits, or taking the tax credit now. So that's where SMEs are probably going to really miss out on. On the flip side, under the large company scheme, the RDEC, they have increased the tax credit amount from 13% to 20%, which is probably good news. And I suppose the whole idea of this was to help clamp down on spurious claims.
Yes.
But I suppose the question is, does it really clamp down on it? Or does it actually just get them to pivot to go, actually, we're not going to claim SME relief, maybe we'll do some RDEC instead, and suddenly all of these companies will be outsourcing to large companies for their R&D, or taking state aid, claiming their employees' allowance and going, all right, well, yeah, well, actually, we're doing RDEC now. It's just, I think it's lazy almost in terms of what they've put in place to, or I don't know, is it entirely, do they actually believe that this is going to help clamp down, or are they just trying to kill two birds with one stone here? The jury's still out on that.
Yeah, and it's funny, isn't it? Because as he announced those cuts, he talked about the avoidance, people abusing the R&D credit scheme. And it kind of almost, I thought it was going to lead into, we're going to clamp down on that. And then actually what he did was reduce all these rates. And I think, would they have been better just actually targeting and tackling those serious claims, like you say?
Because a benefit's a benefit still. Like, people are still going to claim it even if it's a reduced. It's not at any point someone goes, actually, it's not worth it anymore. It's always going to be worth it if you're going to save tax. Yeah. So people are going to continue doing it. They're just going to have less fraudulent claims in terms of value, but probably not in number. Because
we see it quite a lot, don't we? People making claims that really they shouldn't have made.
Yeah.
Or people coming to us saying, I want to make this claim, and we say, no, you can't.
Yeah.
And you do, and that it really isn't within the spirit of what that relief was intended.
Not at all, no. And I think the press, a lot of stuff's been front loaded with all of these ridiculous claims that are being kind of picked up on about kind of vegan menus on restaurants and stuff, where you're just like, that's not R&D.
It's not R&D.
So again, I was similar to you, hopeful that if anything was announced on R&D, it would be more on the clampdown side of things. I mean, what I would say is that they had obviously made announcements prior to November, a few months ago, about changes that were going to come into effect in April anyway, around an element of that was around the compliance side, and they're going to be launching this R&D portal, which will change fundamentally how you submit your R&D, and also that puts more emphasis on you actually on the timing of when you claim it. So they want to remove the opportunity for people to use it as a last minute tax planning tool. Right. So this idea of getting your corporation tax return or comp and going, is that how much tax I've got to pay? Surely not. Right, okay, we're going to make an R&D claim. So they're trying to avoid that. We still haven't had a huge amount of details on how that's going to work in practicality, because there are going to be occasions where R&D is just going to come out in the wash eventually, and it's going to be legitimate R&D which just wasn't picked up on because people aren't always aware of it, and accountants and tax advisors don't necessarily have their own idea of what R&D is and don't necessarily have the time or the inclination to go to every single client and talk about R&D, because it's very difficult. But so there are those changes that were announced a few months ago in relation to that will still be taking effect from April on top of these changes to the actual claims as well.
Yeah.
So
that'll be keeping you nice and busy, Jack.
It will be keeping me nice and busy. So we'll put through all of the claims that we can as soon as possible to justify it. And it's probably ruined my Christmas now, because everyone's going to be like, right, let's get these claims in, come on, quickly. But it's going to be fine. It'll be fine. I don't think there's anything else on the corporation tax side of things. Is it worth kind of finishing off on a couple of other things? So VAT?
Yeah, VAT, again, nothing exciting. The threshold's £85,000. It's staying there. That's here to stay until March 2026. It's been with us for a couple of years, I believe, as well.
Yeah.
So it's just given us that stability of knowing that's exactly what it's going to be for the next couple of years. And stamp duty, land tax, he did make reference to the property market and the fact that we're seeing a slowdown in the property market. He has noted the policies put in place in September are here to. They've basically said that they're going to keep those in place. So the nil rate amount, if you like, is going to be up to £250,000 as previously announced on the stamp duty. That is in place until March 2025, I believe. So,
right.
And that's really, I think, all the taxes covered. There were some rules on non-doms. Again, I'm not going to go into any detail on that. It's in our budget pack. If anyone's interested, they can have a look at that.
That's a good point, yeah, because there's obviously the spending side of things which people may be interested in, business rates and stuff, which we're not going to go into, but it is, all of that information is in our autumn statement pack, which we pulled together and is available, and I think we'll be sending it out to majority of our clients on the mailing lists.
I think it may have already gone today. If not, it will be hitting your inboxes.
So
imminently.
But if anyone hasn't received it, who is a client, or anyone who's not one of our clients who would be interested to find a bit more, obviously it'd be great to either reach out to myself or Lorraine. Yep. Lorraine's probably the best person, being the tax expert, or anyone in your team. And obviously you're going to be potentially very busy with the limited changes that have been introduced, but there'll still be people that will probably still have questions.
Yeah, and I think there'll probably be a need for some remuneration planning for those people who are earning in that £125,000–150,000 mark. Capital gains, I think there'll be people wanting to accelerate some disposals, and conversations need to be had with fund managers. If you've got money invested with a fund manager, they generally are making disposals every year up to your annual exempt amount. So I'm sure they'll be on this. And they will know exactly that the annual exempt amount's about to change, but just to give a heads up on that.
Absolutely. Perfect. Well, I think we've, in a very succinct way, managed to cover, all of the major bases. Thank you very much for joining me, Lorraine. It's been very illuminating, and I've thoroughly enjoyed it. As always, love to get your thoughts on this. If you've got any areas that you think we covered, or any other further questions, feel free to reach out. Obviously, any other topics going on to the future, again, we'd love to hear from you about that. And in the meantime, thanks very much for joining us, and we'll see you on the next one.